welcome to this webinar. My goal on this webinar is to actually end this call with you so excited about your businesses that you won't be able to sleep tonight. Cool. So, hey everyone, my name is Darren Isaacs. I'm a proud accountant, and I also happen to be the founder and CEO of Makosi. Since 2006, Makosi has helped literally hundreds of firms tackle this nasty villain that has been plaguing the audit industry for decades. And in some cases, we've helped firms increase their net profit per partner by up to 15% and reduce attrition by over 50%. We work with firms in the top 10 all the way down to really specialized small firms doing really, really cool advanced stuff. And the reason for this is that the entire industry is dealing with the same issue. So yes, whether you're a top 4 firm, a generalist, a specialist, or just a local tax office, you've all been dealing with the same issue. We call this problem the growth ceiling. And it's this idea that, firms are either turning away work because they don't have the resources, or they might be caught in this constant loop of, I don't want to go and sell a piece of work that I'm not sure that I can go and deliver on. And at the same time, while all of this is happening, HR teams are struggling with attrition and balancing their campus recruiting with experienced hire recruiting as well. Right, so it's become very, very difficult to grow our firms in a predictable, reliable way while increasing profitability. I hope that makes sense. I can't see people's videos on this webinar, but I can literally feel the nodding of heads on the other side of the screen. A little bit of housekeeping. It is a short webinar. We've only got 30 minutes here. So if you don't mind, use the Q&A box. Pop your questions into that Q&A box, and a member from my team will get back to you. Get back to you there. So don't chuck it in the chat box. Use that Q&A box. We will get back to you on all of the questions that you ask. So what we're going to do is we're going to show you a strategy that is not only going to allow you to break through that growth ceiling, but it's also going to improve employee morale and retention. It's going to create flexibility in your planning process, reignite your succession planning, drive innovation for the future of your firm. And we only have 30 minutes for this. But honestly, if anything takes longer than 30 minutes to explain, it's probably too complicated and destined to fail anyway. So let's go. So, 2 truths and an irony. Here's what you need to know. There's an irony that as accountants, we do a pretty lousy job of managing our own P&L. So it's pretty controversial. There's an irony there, and it's pretty crazy, but it's true. So we need to be aware of this. The organization needs to be aware of this, that just because we're a bunch of accountants doesn't mean we're good operators and maximizers of the value of our firms. And we see 2 clear issues with this. The first issue is what we call the language barrier, right? It's the fact that HR and the CFO don't speak the same language. I mean, is anyone surprised by that? This is really difficult. So what we want to do is we want to give you some tools to become fluent in the dynamics of profitability. And, let's help the HR people speak the same language of the CFO and vice versa for everybody's benefit. The next issue is around flattening the utilization curve. Now, flattening the utilization curve has so many benefits, but firms just seem totally paralyzed around how to actually do this. A flatter utilization curve, it means your people are busy year-round at a normal level instead of going through huge swings, being burnt through that busy season and then dying of boredom through those slower periods. For HR, a flatter curve will mean different things to different people in your business. For HR, a flatter utilization curve drives engagement, drives retention, and ultimately it drives referrals, right? But for the CFO, it means a new lever to increase profitability. And so, but as a managing partner or CEO of your firm, trust me on this one, a steady utilization curve is way more important than the busy season for the long-term success of your firm. But let's tackle these things one at a time. The language barrier. The biggest disconnect between the CFO and HR, as far as we see it, is how much do our people actually cost us? HR sees what it takes to find, recruit, onboard, train, engage, develop, I mean, it's just completely overwhelming how much is going on there. And HR knows that this must be costing an absolute fortune. But at the same time, the CFO finds it difficult to directly attribute the cost of all of that machinery, attribute that cost to gross margin or SG&A. And so, put a different way, the accountants in the organization are a little bit detached from the coalface and might not understand what goes on in HR, and as a result, how to account for it. So again, there's an irony, a little bit controversial. I'm not here to pander to the accountants. I'm here to help you guys. So I'm going to make this really, really simple for you. The conservative way to measure the true cost of your resources is by taking their base pay plus their bonus and adding 60% to that. In other words, your people cost you 60% more annually than you actually pay them. And so for the CFOs, we highly recommend using standard costing, factoring a 60% upcharge in the cost of your labor, and applying that to your gross margin calculations and budgets going forward. For the HR people, now you know 60% as far as we see it. So let's actually figure out how we got there. So let's take the typical cost of an audit senior, around about $95,000. We like to focus heavily on the audit senior population for demonstration purposes, but let's start tacking on those additional expenses there. Now, obvious one is taxes. 9.5% is what we see. Yes, we're going to have 200 accountants on this call jumping up and down, but let's use round numbers, right? The next item is benefits. The US Bureau of Labor Statistics estimates between 20 and 35% should be allocated to additional benefits for your people. So we'll add 25% roughly there. Pretty basic stuff here. But here is where it gets a little bit interesting as far as our perception of the environment. The first one is the cost of a bad hire. Now, it's been estimated that a cost of a bad hire is 30% of the employee's salary. So if you hire someone, if you hire poorly, it's likely going to cost you 30% of that person's salary if you make a bad decision. So in this scenario, we're going to assume that you are very good at hiring great quality people. We're going to assume that you have a 75% success rate. That's why we're only applying 7.5%, the cost of a bad hire. The next piece is recruiting and training. The US Department of Labor estimates that to hire, to recruit, onboard, and train an individual costs roughly 6 to 9 months of their salary. So pretty expensive situation, particularly in public accounting with the amount of training that needs to go into our people. It is going to cost you at least 75% of the cost of that person to onboard and train them. Now, obviously, that's in theory a once-off cost, but we factor in a turnover rate, an attrition rate of 25%, which is actually quite low for the industry. So these are actually pretty conservative numbers in terms of the costs that get added onto that individual that walks through the door on day one. That brings us to an annual cost of $152,000 US on a $95,000 salary. Okay, so, and again, this is fairly conservative from our perspective. So let's take a round number, 150,000 there. The next piece of it, this is the real meat of what we're going to talk about here. So let's hack this utilization curve. Now that we know how much our people cost, how do we maximize profitability, get the most out of them by flattening that utilization curve? What we're going to do, we're going to run through the current model that most of the industry uses. And so let's map out the months of the year. And, at least in our US geographies, we have this really heavy, busy season, the first 4 months of the year. And then we have the off season a little bit later on. We've kind of typified the hours that would get billed over that period. Type of utilization curve there, 1,500 hours we would estimate as a kind of a typical low-end scenario. We're going to work with a hypothetical audit firm here. We're going to allocate, in this particular firm, they have 50 audit seniors, billing those hours on that first line, coming up with 75,000 total hours for the year, 45,000 hours billed in the busy season, 30,000 hours billed in the off season. And that's very, very common. We see most of our clients, really bill at least 60% of their hours in the first 4 months of the year, which is a big part of our solution here. So nothing really fancy. To come to the total cost of our labor in this scenario, we take that $150,000 we spoke about earlier, multiply that by 50, and we come in at $7.5 million for the cost of our team. The last item at the bottom there is that $100 per hour, per billable hour. We always look at profitability in a per billable hour basis. So obviously, if we had to increase the hours billed and allocate that over $7.5 million, our cost per billable hour will come down. And that's the crux of this whole strategy. And that's kind of what our utilization curve looks like in this particular firm. Now, I want you to bear with me on this one. There is, in our opinion, there's a very good chance that this firm is actually way overstaffed. They got way too many people. And even though the firm needs 50 people to get through that busy season, in this scenario, we feel that they're very much overstaffed. And so what we're going to do is we're going to remove 12 full-time employees from that workforce, and we're going to reduce the total FTE to 38. Now, we've saved $1.8 million in the process, but somebody from planning is going to have an absolute heart attack that we are now 10,800 hours short for busy season. Like that is not something that the planning group is going to tolerate. So how are we going to get through that? We're going to bring in an on-demand workforce for the additional 12 people, bringing up our busy season staff complement to that 50 people, allowing us to get through that busy season, those 45,000 hours, so we did not have a deficit there. But what we noticed with that scenario, because we don't have the on-demand workforce in the off season, that we're 7,200 hours short. This is where we flatten the utilization curve. So we recoup those off-season hours. We simply increase the hours per FTE, flatten the utilization curve. So we become really smart with our planning, with our scheduling, and we increase the total billable hours for our consultants from 1,500 hours to 1,690. And we aren't stressing our employees. We're getting more out of them. We're actually keeping them way more engaged by keeping them busy. So I hope this makes sense so far. Now, by optimizing the number of FTEs and flattening the utilization curve, we create massive savings in our workforce costs. In this example, after paying for that on-demand workforce, this hypothetical firm saves $882,000 or 12% of the cost of their labor. That 12% goes straight to the bottom line of your business, and fireworks go off in the CFO's head. So seriously, it's that simple, but there are additional benefits for this model. What you also gain is a way more engaged workforce because people are busy. Also, how do you actually get from those 50 people down to the 38? We recommend starting with those really low performers. What a lot of firms make a mistake with is they end up hanging on to those low performers or those average performers just so that they have the hours, just so that they can get through that busy season. And it creates a really bad environment. What you want to be doing is running a high performance organization, high performance culture, remove those low performers, and have a team of people that is in front of your clients, driving great client success, high quality audits, and overall building a way better firm. The other way to do it is just to, if you already have all high performers, you just let that natural attrition reduce your level of FTEs so that you can build a way more nimble workforce and become way more profitable. What we're going to do though is we're going to push this model a little bit further, because in my personal book, 1,690 hours needs a little bit of work. In our estimation, after allowing at least 100 hours of professional development for your people, the ideal annual billable hours is around 1,900 hours, 1,950 hours roughly. So let's actually push this model a little bit further and see what we kind of achieve once we've hit that workforce nirvana. I'm going to take the same scenario or building off the ideal case from earlier. And what we're going to do is, again, we're going to look at the hours that people are working over those different seasons, the number of FTEs, and the size of that on-demand workforce during that busy season. We're going to convert this into a scenario where we reduce our FTEs to 31, and we bring in an on-demand workforce of 19 people. In the process, we flatten our utilization curve again, because we're able to get through the busy season. It's the off-season hours that we want to get up, and we get them up over fewer FTE without additional costs. And obviously that drives our profitability up. Bringing in this scenario, our total billable hours to 1,868. What that does in that ideal model is it saves the organization $1.4 roughly million on a $7.5 million base. That is a massive 19% saving on your workforce strategy that, again, goes straight to the bottom line. So pretty compelling. And so to summarize, it is so hard to recruit and retain people. Use attrition or your performance management process to reduce the number of FTE in your organization to a reasonable level, leaning on an on-demand workforce to fill in that gap during those busiest periods. Increase those off-season hours, flatten the utilization curve, and keep your FTE busier during those quiet periods for unmatched results, quality, and optimized firm profitability. So now, just think about it. Imagine you are HR, and you call up that CFO and you say, I'm going to add 12 to 19% to our bottom line without adding anything to the top line, while improving morale, quality, realization, and driving innovation for our firm. Now that would be a pretty awesome day. So here's what I want you to do, right? If this made sense, and I hope it made sense, if this made sense to you, take the lead, grab your CEO, your head of HR, and your CFO. You need those three people. Show them a recording of this webinar, which you'll be able to access on our website. Then sit down as a team and collect the following pieces of information: your current net profit per partner, the number of seniors, the mid-range comp of those seniors, your current billable hours, right? Your busy season versus off-season split. How are you splitting performance with your current people? You know, your split of 1s through 5s in performance scales. Get everybody clear on where the business stands today and start imagining what is possible. Take these numbers and go to Makosi.com and use the calculator that we've built free of charge. There's a calculator on our website that you'll be able to pop in a bunch of numbers, and it will determine the optimal workforce for your firm. Once you've done that, the results will be pretty simple, pretty compelling. And my hope, again, is that you'll get so excited about your business that you literally won't be able to sleep. So again, thank you so much. That's it. Thank you for joining. It was honestly a real privilege presenting to you. And as mentioned, if you haven't already done so, pop those final questions into the Q&A box, and our team of experts will get back to you directly with answers. From me at the team at Makosi, please go well and be well. Thank you for attending.